Hey everyone, I'm just one person hidden deep in the countryside, surrounded by silence. But I built Block Sonic to speak with the entire world. Here, you don't get noise, you get the pulse of Bitcoin every single day, distilled into pure essential updates. No teams, no sponsors, no filters. Just me, a signal from the quietest place on earth, bringing you the most important Bitcoin news before the world wakes up. With Block Sonic, you don't need to search for information. I research, I write, and I tell the story behind every headline. I do the digging. I chase the truth. All you have to do is listen. Today, our news begins with the title. When you see the liquidations, you see the leverage. And if you stay with us, you'll notice how a sudden drop is rarely just a drop. It's a map of hidden promises being forced into daylight. You've watched Bitcoin and Ether slide more than 7%, while fear readings sink to extremes. We'll trace what that fear really does. It doesn't merely change opinions. It changes margins, triggers liquidations, and turns crowded trades into exits with no room. We'll also look at the temptation to treat one chart as fate, those 2022 echoes, the straight lines pointing to dramatic targets, and ask what is knowledge and what is pattern hunger. Then we'll move outward. Oil volatility, rate uncertainty, software shares moving with crypto, and even a treasury choosing one token. Because when incentives shift, prices speak, and they never speak at random. When fear rises, Bitcoin and Ether fall, and liquidations reveal the hidden leverage. You are watching a market confess something it usually hides. Not just changing opinions, but crowded bets that cannot endure a change in price. We will trace how a 7% drop becomes a chain reaction, why extreme fear is both a warning and an invitation, and what happens when a widely watched level fails to hold. You feel the paradox immediately. The price moves, but the real violence comes from positions that were built as if price would never move. Over the last 24 hours, Bitcoin and Ether extended their descent, each falling by more than 7%. But we should not treat this as a mere change in mood. We should treat it as the visible output of many private plans colliding under scarcity, uncertainty, and leverage. When traders borrow conviction, they also borrow fragility. A leveraged position is a promise to the future that the future did not sign. When price moves against that promise, liquidation is not a choice made calmly. It is a forced trade, executed because the margin is gone. Now, notice what the fear gauge is really measuring. The fear and greed index fell to 11.00, the lowest reading this year, signaling extreme bearish sentiment. Yet, sentiment is not a substance floating above the market. It is the shorthand for countless individual valuations being revised at once, often under the pressure of losses. Here is the first quiet hook to hold on to. Extreme fear can appear at the same time as genuine opportunity, because both are born from the same mechanism: sudden, urgent selling. One analyst observed that Bitcoin has returned to a zone that previously acted as strong resistance from March to October of 2024. You can understand why this matters without any mysticism. A level becomes important when many actors remember it, because memory shapes plans. Those who regretted not buying earlier see a second chance. Those who bought late and suffered see a chance to escape. The same price can be a doorway for one person and an exit for another. And this is where conflict enters the picture. If bargain hunters are real, they must absorb the selling. If they are only hopeful, they will step aside the moment the market tests them. Support is not a line on a chart. Support is the willingness of real buyers to spend scarce funds at that moment rather than later. A second comparison sharpens the tension. In a similar phase of the cycle, an intense sell-off in May of 2022 ended with price holding near one level for about a month, and then falling further. Do not treat this as prophecy. Treat it as a reminder that markets can pause without healing. Consolidation can be rest, or it can be the market gathering the remaining sellers who still need to be forced out. Now let us name the amplifier, because without it you will misread the whole scene. Derivative selling and leveraged positioning can compress price action downward, not because derivatives are evil, but because they concentrate risk into structures that unravel quickly. When liquidation waves begin, they add supply that was never planned as voluntary selling. Price then becomes the messenger of a sudden imbalance, and the message is delivered loudly. Midway through this, you may ask a deeper question. Why does the entire board fall together, even assets with different stories? Because in moments of stress, portfolios are not managed by narratives. They are managed by constraints. When margin calls arrive, people sell what they can, not what they philosophically dislike. Correlation rises because scarcity becomes the dominant fact. The environment outside crypto also presses on these choices. When uncertainty rises around interest rates and broader risk appetite, traders often retreat from higher volatility assets. This is not a moral judgment. It is a re-ranking of priorities under uncertainty, a shift in time preference towards safety and liquidity. And then comes the overlooked bridge between energy and money. Oil volatility remained elevated, with markets pricing the possibility of escalating tensions between the United States and Iran. If oil spikes, it can feed an inflationary impulse worldwide. That matters because inflation is not an abstract statistic, it is a distortion of calculation. When people cannot forecast their costs, they shorten their horizon. When horizons shorten, speculative positions become harder to justify, and the appetite for risk thins. So you see the structure now. Price declines, liquidations accelerate. Fear becomes visible, and external uncertainty tightens the room in which all plans must fit. We will end with a calm thought, because clarity is the point. What you are witnessing is not chaos, it is coordination under stress. The market is discovering in real time how much leverage was silently embedded in yesterday's confidence. If you have ever felt that fear in markets looks irrational, hold this lens instead. Fear is often the moment when hidden promises are forced into daylight. If you want, tell us what level or signal you watch to distinguish a true bargain from a temporary pause. When one chart feels like fake Bitcoin and the return of 2022. You are watching people search for order inside a storm, and we are watching the search itself. One famous skeptic points to a single past collapse and says the present is rhyming. We will ask a quieter question. When does pattern become knowledge, and when is it merely comfort? You feel the tension immediately. Markets move, and the mind reaches for a story that makes the movement legible. We should begin with human action because every chart is only the residue of choices. Some people fear loss more than they desire gain, so they scan the past for warnings. Others crave upside more than they respect uncertainty, so they scan the past for prophecies. The bear and the bull are not opposites in method. They are twins in appetite for certainty. You can see why a well-known doomsday caller draws attention. He has a reputation built on noticing fragility before others admit it exists. And now he looks at Bitcoin's ongoing decline and tells you it resembles the brutal unwind of 2022, as if the market were stepping back onto an old set of tracks. In a post on X during early Asian hours on Thursday, he highlights a specific path, Bitcoin falling from an October high of $126,000 to around $70,000. He places that beside the late 2021 and 2022 descent and claims the shapes match so far cleanly, almost perfectly. Here's the seduction. If the path matches, then the destination feels implied. In that earlier cycle, Bitcoin fell from roughly $35,000 to below $20,000 before stabilizing. If you map that proportional move onto today's levels, you are led toward the low $50,000 range. Notice what happened in your mind as you heard that. You did not merely compute. You imagined. You began to feel a future as if it were already partly known. He does not state a precise target, and that restraint is part of the power. A picture can suggest what a sentence would be forced to defend. So the comparison reignites the old argument. Is Bitcoin repeating a script, or are we stretching analogy until it snaps? Now meet the first honest objection, and it is simple enough to carry in one breath. Analysts and traders ask whether a single historical instance can be called a pattern at all. A trading firm named GSR gives the question its cleanest form. Is it a pattern if it happened once? Let us pause here, because this is where reason quietly takes the wheel. A pattern is not a drawing that resembles another drawing. A pattern is a recurring relationship that survives changes in circumstance. Without that, you have resemblance, not explanation. And circumstances matter because prices are messages, and messages depend on the environment in which people speak. The 2021 to 2022 collapse unfolded under very different conditions. Aggressive tightening by the Federal Reserve, collapsing leverage native to crypto markets, and heavy participation from retail crowds, learning risk the hard way. Today, you are looking at a different architecture of action. Spot Bitcoin, exchange-traded funds exist. Liquidity is deeper and more institutional, and the broader backdrop is shaped less by a simple march of rate hikes and more by cross-asset volatility tied to equities, commodities, and fears around artificial intelligence spending. So we arrive at a second tension, more subtle than the first. Even if two charts look similar, the coordinating forces underneath can be entirely different. The same silhouette can be cast by different objects depending on where the light stands. Still, his timing lands because the market itself has been emotionally loud. Bitcoin has whipped sharply this week, dropping below $71,000, rebounding, then slipping again as risk appetite deteriorated. When movement becomes violent, the demand for narrative rises, because people want a reason to hold, a reason to sell, or a reason to wait. And this is why his history matters even when his calls divide opinion. His method often centers less on precise forecasting and more on positioning and psychology, on the moment when conviction fades and rebounds fail. In that sense, the chart is not a prophecy. It is a warning sign placed near a bend in the road. So what should you take from this, calmly without theatrics? You should see that a chart comparison is a claim about human behavior repeating under similar incentives. If the incentives are not similar, the resemblance is fragile. But you should also see the opposite truth. When a market is crowded with confidence, it does not take identical conditions for disappointment to cascade. It only takes enough people discovering at once that their plans cannot all be fulfilled at the same prices. We can end with a quiet thought. The real question is not whether Bitcoin will revisit the low 50,000s. The real question is whether you are using the past to illuminate uncertainty or to anesthetize it. If you have your own way of deciding when resemblance becomes knowledge, hold it up beside this moment and see what it reveals. If you believe in what we're doing and want to support Blocksonet's growth, just scan the QR code on the screen or copy the link in the description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. When fear speaks loudest, Bitcoin slips under $70,000 before equity trading begins. You are watching a familiar separation unfold. Digital assets and metals tremble while equities appear calm. We will trace how sentiment becomes action, how action becomes price, and why resilience in one corner does not cancel distress in another. You and we both know the first truth of markets. Prices move when people choose, and people choose under uncertainty. Before equity trading begins in the United States, Bitcoin falls below $70,000, and the sell-off in digital assets deepens. The number itself is not magic, but the crossing matters because many minds anchor to round thresholds, and anchored minds act together. Now notice the next layer. Sentiment is not a decoration added after the fact. Sentiment is a summary of countless private valuations, whispered through bids and asks. Bitcoin trades down to roughly $69,917, and measures of mood slide into what observers call extreme fear. The Fear and Greed Index sits near 11, a reading reached only rarely, which tells you something simple and human. When uncertainty rises, the marginal seller becomes easier to find than the marginal buyer. Here is the paradox that catches your attention if you let it. The turbulence is intense, yet it is not everywhere. The sell-off remains largely contained within digital assets and metals, while broader United States equities look resilient. This is not contradiction. It is specialization. Different crowds hold different expectations, different time horizons, and different constraints. A single story does not govern all portfolios at once. Metals, often treated as a refuge, are not immune to liquidation when people need cash or reduce leverage. Gold falls more than 1%, slipping below $4,900 per ounce. Silver drops over 11%, falling under $79 per ounce. You can feel the quiet logic here. When fear becomes a scramble for liquidity, even the assets people call safe can be sold, because safety does not pay the bill that is due today. Meanwhile, equities in the United States are slightly higher in pre-market trading. An exchange-traded fund that tracks the NASDAQ 100 is up about 0.05%. That small rise does not mean confidence is universal. It means that, for now, the marginal buyer in that arena is still willing to step forward. But you should not miss the internal split inside equities themselves. Companies exposed to Bitcoin extend their declines. Strategy, known for holding large Bitcoin reserves, is down over 5% and far below its November 2024 peak. The approach that looked invincible on the way up becomes fragile when the price of the underlying asset falls, because the market starts to reprice not only the asset, but the financing, the patience, and the tolerance for volatility. And here we meet a midstream question worth holding. When an operating company becomes a vehicle for an asset, what exactly are you valuing, the business or the bet? Other Bitcoin treasury companies fall as well, down roughly 6%. Crypto exchange Coinbase is lower by another 2%, while Bullish, the owner of CoinDesk, is down a fraction. In periods like this, the market does what it always does. It does not merely mark down the asset. It marks down the entire ecosystem of revenues, balance sheets, and expectations built around that asset. Mining-related equities show a more uneven picture, but the direction remains heavy. Some miners are down a few percent after steep declines the prior day. Large miners with significant Bitcoin holdings are also lower by roughly 3%. You can deduce why without drama. Miners are businesses whose costs are immediate and whose revenues are volatile. When the output price drops, the margin compresses, and the market re-evaluates survival, not just profitability. Still, reason asks you to look for the connecting thread. If correlations hold, some relief could appear through the technology sector that Bitcoin has often tracked. A technology software fund is slightly higher, hinting that the broader tech mood is not collapsing in tandem. Yet correlations are not laws of nature. They are habits of crowds, and habits can break the moment incentives change. One more detail sharpens the picture. A major technology company reports strong profits, yet its shares fall after announcing higher capital expenditures, rising to about $185 billion from $175 billion, with estimated spending near $119.5 billion. Profit beats do not guarantee price gains when the market is recalibrating the cost of growth. Even in equities, you are watching the same principle. Future expectations, not past results, set today's price. So what are we really seeing together? We are seeing dispersed knowledge trying to coordinate under stress. Fear is not a mysterious force. It is the name people give to a sudden revision of plans. Some revise by selling Bitcoin. Some revise by selling metals. Some hold equities steady. Each choice is purposeful, each choice constrained, and the price system records the net result with indifferent precision. If you want a quiet question to carry forward, hold this one when the next wave of uncertainty arrives. Which assets in your own mind are truly long-term, and which are only long-term until volatility demands a decision. When the price of Bitcoin falls below the miner's cost, the network reveals its discipline. You and I are watching a quiet squeeze. Bitcoin trades beneath the average cost of bringing new Bitcoin into existence. And that single gap forces hard choices that no speech can soften. You might think the price is the story, but the paradox is deeper. The very process that secures Bitcoin becomes most selective precisely when rewards feel least sufficient. Bitcoin is trading near $69,270, while the estimated average cost to mine one Bitcoin sits around $87,000. Hold those two numbers together, and you can feel the pressure without any commentary from us. When the market price falls below production cost, many people call it a bear market. We can translate that into the language of action. The revenue from producing a unit no longer covers the full sacrifice required to produce it, so the marginal producer is pushed toward exit. Now ask yourself how anyone even estimates a production cost for a global swarm of miners. The model used here takes network difficulty as a proxy for the all-in cost structure, because difficulty is not a slogan, it is a constraint. It reflects how much computation must be spent to find the next block, and computation is always paid for with scarce resources. From there, difficulty is linked to Bitcoin's market capitalization to infer an average cost. This is not perfect knowledge, because no one possesses perfect knowledge. Yet it is a disciplined attempt to read the industry's cost reality through the only honest window we have, the network's own measurable resistance. We have seen this pattern before. In earlier downturns, such as 2019 and 2022, Bitcoin traded below estimated production cost, and then, over time, drifted back toward it. Not because anyone decided it should, but because losses force adaptation, and adaptation changes the structure of costs. Here is the midpoint tension you should not miss. When miners suffer, the network does not beg for them to stay. It adjusts. Hash-rate, the total computational power securing the network, peaked near 1.1 zettahash per second in October, then fell by roughly 20% as less efficient miners were forced offline. That decline is not merely a technical metric. It is the visible footprint of entrepreneurs discovering error under uncertainty. Some miners learned in the hardest way that their energy contracts, their machines, or their debt terms were built for a world that no longer exists. More recently, hash-rate has rebounded to about 913 exahash per second, hinting at stabilization. Notice what that implies. Some operators can still produce under these conditions, or they have found cheaper inputs, better machines, or more patient financing. The network becomes a sorting mechanism. Yet many miners remain unprofitable at current prices. And when revenues do not cover operating costs, action becomes narrow and immediate. They sell holdings to pay for daily operations, to cover energy expenses, and to service debt. This is what people call capitulation, but we can see it more clearly as liquidation under constraint. The miner is not panicking. The miner is choosing between obligations, and the most liquid asset becomes the tool for survival. So the sector's stress is real, but it is not chaos. It is the discipline of scarcity working through a price that refuses to flatter anyone. And if you sit with that, you may notice the quiet lesson. Bitcoin's security is not maintained by promises, but by continual cost-bearing and continual selection. If you have ever wondered what it means for a system to be governed by incentives rather than declarations, keep this episode in your mind and tell me what detail you think most people overlook when they talk about miners and the price. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. When a straight line tries to predict Bitcoin's next fall to $38,000, you can feel the temptation, can you not, to turn uncertainty into geometry. Today, we walk through a forecast that claims Bitcoin may sink toward $38,000, and we ask what such a claim truly rests on. A pattern of past crashes, a story about money's weakening, and a sudden reversal in how Bitcoin moves with the dollar. We begin with a simple fact of human action. When prices fall, minds search for a floor. So you see a quiet race among analysts to name the lowest point Bitcoin might reach, and the targets seem to descend as quickly as confidence does. A well-known financial services firm based in St. Louis, Missouri enters this race, and its analysts offer a number meant to sound precise: $38,000. Now notice the method, because the method is the message. They look backward and draw a straight line through the low points of major Bitcoin crashes since the year 2010. They list the old collapses in stark percentages: about 93% in the year 2011, about 84% in the year 2015, about 83% in the year 2018, and about 76% in the year 2022. Connect those bottoms, they say, and the line slopes upward until it points to a new possible nadir near $38,000. Here's the paradox you should sit with for a moment. A market made of changing plans, changing fears, and changing constraints is being summarized as if it were a ruler laid across history. And yet we understand why this seduces people. The future is uncertain, and a line feels like knowledge. It feels like calculation without the pain of judgment. But a line cannot know why each previous bottom formed, who was forced to sell, who was free to buy, and what new information repriced the world. Still, the analysts anchor their claim in the present drama. Bitcoin, they note, once traded above $126,000 in October, and then slid down toward about $70,000, revisiting levels last seen in November 2024. When a price returns to an old level, many observers treat it like destiny. But an old price is not a law of nature. It is a record of past trades under past conditions. Now we reach the part where they try to explain not only the number, but the meaning. They borrow an analogy from the story of Benjamin Button, the character who grows younger as everyone else grows older. They suggest Bitcoin once behaved like that character. As the supply remained fixed at 21 million Bitcoin, Bitcoin seemed to strengthen while the dollar weakened through repeated creation of new money. Pause with us here, because this is where a real question lives. A fixed supply can indeed change the long-run story of a money-like good, but it does not abolish the short-run reality that people hold assets for reasons and sell them for reasons. Scarcity is not a shield against changing time, preference, leverage, forced liquidation, or shifting expectations. Their analogy turns darker. They say Bitcoin is now fraying, like a child who looks young but acts old, trapped playing piano for retirees. What they are pointing to is not poetry. It is a claim about correlation and regime change. Bitcoin used to rise when the dollar fell, but since the year 2025, they argue the relationship has reversed, and Bitcoin has fallen alongside the dollar. Here we should ask you to notice something subtle. When someone says a relationship has reversed, they are confessing that yesterday's simple rule did not hold. And once yesterday's rule breaks, the mind becomes hungry for a new rule, even if the new rule is just another temporary pattern dressed as permanence. They support this with an observation about the dollar index, which they say has fallen by nearly 1% this year after a decline near 10% last year. The implication is clear. If the dollar is weakening and Bitcoin is no longer benefiting, then Bitcoin has lost its former role in this particular narrative. But we must keep our feet on the ground. Correlation is not a cause. If Bitcoin falls while the dollar falls, it may tell you less about Bitcoin's essence and more about the shared conditions pushing investors to reduce risk, meet obligations, or unwind crowded positions. Now comes the next link in their chain. Bitcoin's growing tendency to move with technology-heavy equities, especially the NASDAQ 100 index and growth stocks. This is not a mystical bond. It is a practical one. If many holders treat Bitcoin as a risk asset, then their buying and selling will naturally synchronize with other risk assets when fear or relief spreads through portfolios. And what do they place at the center of the synchronization? Changes in expected interest rates and the tone of central bank communication. They note that interest rates were cut in the final 3 meetings of the year 2025. Yet the messaging remained cautious, discouraging expectations of faster cuts ahead. Here is a midstream hook worth your attention. A cut that sounds restrictive can tighten conditions even while the number moves downward, because entrepreneurs and investors act on expectations, not on labels. They then extend the argument to borrowing. If technology companies are borrowing more heavily, and if borrowing costs rise, then financial conditions tighten. Tighter conditions can compress valuations, pressure leveraged positions, and spill over into any asset that is held in the same speculative basket. In that world, Bitcoin does not need a special floor to fall. It only needs to be owned by people who must sell when the margin clerk calls. So what have we really uncovered together? Not a prophecy, but a structure of thought. A straight line through past bottoms is an attempt to replace understanding with a shortcut. A movie analogy is an attempt to make a complex shift feel intuitive. And the talk of reversed relationships is an admission that the market is a living process, not a stable equation. If you want the quiet truth beneath the forecast, it is this. Prices are not guided by lines. They are guided by choices. And choices change when constraints change. Let us end calmly. The number $38,000 may arrive, or it may never appear. But the deeper lesson is already here in plain sight. When people cannot explain a moving world, they reach for patterns that look certain. If you have seen that impulse in yourself, you have learned something worth keeping, and you may find it useful to write what you think the real driver is beneath the pattern, in your own words. Bitcoin returns above $71,000 as the technology panic loses breath. You are watching a familiar pattern. When fear forces selling, price can rise again without new conviction. We will trace how Bitcoin's rebound can come from traders closing bets, while quieter signals suggest fresh buyers are still waiting. You see Bitcoin fall below $70,000, and then you see it climb back above $71,000 on Thursday. The surface story sounds like recovery, but we should ask a sharper question. What kind of buying lifts a price after a sudden drop? And what kind merely stops the fall? Notice how Bitcoin's movement mirrors the wider mood. When people feel uncertainty, they do not reassess each asset in isolation. They reduce exposure where they feel most vulnerable, especially in areas associated with growth narratives and leverage, because those positions punish hesitation. Now look at the broader backdrop. The selling pressure in technology shares begins to tire. Futures connected to the Nasdaq 100 edge higher after two harsh sessions that erased the index gains for the year. European stocks steady. Asian markets trim losses. This is not triumph. It is simply exhaustion. The moment when the rush to liquidate meets fewer remaining sellers. Over the previous 24 hours, Bitcoin falls as much as 7%. That tells you something about the kind of holders involved in the marginal trade. The more an asset is held for quick repositioning, the more it reflects shifts in risk appetite rather than slow changes in long-term plans. And you can see the same unwinding instinct in metals. Silver plunges as much as 17%, extending a brutal reversal after last month's record rally. Gold slips as well. When many trades are built on the same expectation of continuing momentum, the reversal does not stay confined to one corner. It spreads, because the same people are trying to exit at once. Here is the midpoint tension we should not ignore. A price bounce can be real and still not be rooted in new demand. In crypto, the move back above $71,000 appears driven more by short covering than by a renewed rush of buyers. When traders who bet on further declines buy back to close their positions, they create upward pressure that looks like strength, even if no new long-term buyer has arrived. Volumes remain elevated, which can mislead you if you only watch activity. High volume can mean eager accumulation, but it can also mean frantic repositioning, forced exits, and the mechanical closing of leveraged trades. The question is not whether people are trading. The question is whether they are committing fresh capital to hold. So we look for quieter evidence. Stablecoin balances on exchanges drift lower, suggesting that new money is not flooding in to buy the dip. If the sidelines were eager, you would expect readily deployable balances to rise, not fade. This is the market telling you, in its own language, that caution still dominates. Then we reach the deeper source of hesitation. Macro uncertainty. People are recalibrating expectations about United States interest rates amid speculation over central bank leadership and the possibility of a stronger dollar. When liquidity feels less easy, assets that benefited from abundant credit often feel the pressure first because their recent valuations were partly built on the assumption that financing would remain friendly. Some firms remain cautious, warning that without a clear catalyst, Bitcoin could revisit lower levels if selling resumes. That is not prophecy. It is simply the recognition that in a market still governed by uncertainty, the absence of committed buyers leaves price vulnerable to the next wave of liquidation. Others argue the bulk of the drawdown may already be behind us, with estimates clustering around a potential bottom in the low to mid $60,000 range. You should hear what that really means. People are trying to locate where subjective valuations might finally outweigh forced selling, where the marginal seller becomes scarce and the marginal buyer becomes confident again. So we end with a quiet deduction. A rebound above a round number can soothe the eye, but it does not answer the essential question of coordination. Who is still acting with conviction, and who is merely reacting to pressure? If you sit with that distinction, you will start to see market moves less as mysteries and more as human action made visible. If you have ever felt the difference between buying because you believe and buying because you must, you already understand the entire story, and you may want to leave your own observation where others can test it against their experience. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep Blocksonic running at full speed every day. When a treasury chooses one token, what is it really revealing? You are watching a simple act repeated with discipline. A firm keeps buying one asset on dips, and a founder figure replies with two quiet words that signal persistence. We will trace what this behavior means in the language of human action, and why one token's relative steadiness can tempt people to call it a shelter. You and we both know the paradox. In a world of restless prices, the calmest move can be the most radical one. A wealthy entrepreneur, Justin Sun, looked at Tron Incorporated buying more of the Tron token and offered a brief endorsement. Keep going. You might think this is merely commentary, but in human action, even a short phrase is a signal. It tells you what plan is being protected, what uncertainty is being accepted, and what kind of patience is being demanded. Now let us make the action concrete. Tron Incorporated, listed on NASDAQ, announced that it acquired 175,507 Tron tokens on Wednesday. The average price was $0.28 per token. The total outlay was a little over $49,000. And with that purchase, the firm's holdings rose to about 679.9 million tokens, valued around $540 million. Pause with us here, because this is the first hook of understanding. The purchase is small relative to the total stash, yet it is announced and celebrated. Why? Because the public act is not about the marginal number of tokens. It is about the rule the firm wants you to see. We accumulate through dips. We treat this asset as treasury. We intend to persist. The company says it plans to grow these holdings further to enhance long-term shareholder value. You can hear the language of purpose, not trading for quick gain, but holding as a core reserve. This is not the mindset of the speculator chasing a candle. It is the mindset of an institution attempting to anchor its identity to a particular form of property. And here we meet a quiet tension. Tron Incorporated itself was formed through a reverse merger between SR Entertainment and a Tron-related entity. The structure matters less than the intention. A publicly listed vehicle designed to hold a significant amount of one token and to build a treasury strategy around it. You are not merely watching a portfolio choice. You are watching a firm attempt to turn a volatile market object into an institutional cornerstone. To clarify what they are imitating, the article points to another NASDAQ-listed firm, Strategy, known for popularizing the digital asset treasury narrative by accumulating Bitcoin as a reserve asset, beginning in August of 2020. The pattern is recognizable. Take an asset seen as scarce or strategically important, hold it on the balance sheet, and invite the market to value the company partly through that holding. Here is the next hook. When a firm does this, it is not only betting on price, it is betting on coordination. It is betting that other minds will treat the same asset as meaningful, liquid and durable enough to serve as a treasury anchor. In other words, it is betting that a shared valuation will persist. Sun's endorsement reinforces this interpretation. Keep going is not analysis, but it is a reinforcement of the accumulation rule. In markets, rules matter because they reduce uncertainty about future behavior. If you believe the buyer will keep buying, you adjust your expectations. If you believe the buyer may stop, you price that risk differently. A two-word message can be a small piece of that expectation forming in real time. Now, consider the price story the article gives you. Tron's token peaked near 45 cents in 2024 and later pulled back to about 28 cents. That is the conflict, a fall from the peak tests conviction. Yet the article emphasizes resilience. The token is down only about 1.3% this year relative to Bitcoin, while Bitcoin is down nearly 19%. We should be precise with the deduction. Outperformance here does not mean immunity. It means relative steadiness compared to a benchmark during a particular window of time. When people see relative steadiness during broader weakness, they begin to speak of defense, of haven, of shelter. Some analysts, the article says, have started to view the token as a defensive haven asset. But you and we must ask the deeper question. What makes something feel like a haven? It is not a label. It is the pattern of actions around it. A haven is created when enough people choose it not for excitement, but for preservation, and when they believe others will do the same. The defensive quality is not inside the token as a substance. It is inside the expectations and the repeated choices of holders, buyers, and institutions trying to make a treasury out of it. So when you see Tron Incorporated stacking this token, and you see a prominent figure affirming the act, you are watching an attempt to shape time, preference, and narrative into a balance sheet strategy. The firm is saying, we will endure drawdowns, we will accumulate, and we will ask the market to interpret this endurance as long-term value creation. And now we can end where reason naturally rests. A treasury strategy is not magic. It is a disciplined claim about the future, expressed through repeated purchases in the present. Whether it succeeds depends on whether voluntary valuations continue to coordinate around the same asset. If you find yourself wondering what truly turns a volatile token into something people call a reserve, hold that question for a moment and let it work on you. It is often in the quiet repetition of small buys that the larger logic reveals itself. Bhutan sends Bitcoin toward traders as price slips near $70,000. You are watching a quiet kind of signal. A long silent holder begins to move, not when calm reigns, but when the market trembles. We will trace what these transfers can and cannot mean, why the destinations matter, and what this moment reveals about how large holders treat Bitcoin when uncertainty tightens its grip. You might think the most patient holder moves only in confidence. Yet here we are. Motion arrives precisely when prices fall, and nerves rise. We begin with a simple fact of human action. When someone moves scarce means, they reveal a preference. Not a press release, not a slogan, but an act. And today the act is this. Bhutan-linked Bitcoin wallets, quiet for months, have started to send coins outward. You see the timing and you feel the tension. Bitcoin slid below $71,000, drifting towards $70,000, while broader markets shuddered. In such moments, every transfer looks louder than it would in calm weather, because uncertainty makes observers hungry for meaning. On-chain tracking tied to Bhutan shows more than 184 Bitcoin moved over roughly the last 24 hours, valued around $14 million. Notice what matters here, not only the size, but the break in routine. Long inactivity creates an expectation, and expectation is a kind of fragile order. When that order breaks, minds rush to interpret. Now look at where the coins went. Some flowed to new addresses. Some flowed to known counterparties associated with trading and liquidity, including QCP Capital and a Binance hot wallet. A destination is never a confession, but it is a clue. Exchanges and trading firms exist to make positions mobile, to convert, hedge, borrow, or sell. They are tools for rearranging a balance sheet under pressure. Here is the paradox you should hold gently. Movement toward an exchange can be preparation for selling, and it can also be preparation for not selling. The same road can lead to liquidation, or to collateral management, or to a reshuffle, meant to reduce operational risk. Action tells us there is a purpose, but it does not tell us the entire plan. Still, we should not pretend the context is irrelevant. The transfers arrive at a volatile moment. Bitcoin fell more than 7% in about 24 hours. Silver plunged as much as 17%. Global equities slid as fears spread that artificial intelligence spending may be weakening traditional software business models. When many markets convulse at once, liquidity becomes precious, and even patient actors begin to treat reserves as instruments. Pause here, because this is a mid-course insight. The world does not become unstable because people change their minds at random. It becomes unstable because many people, facing the same tightening constraints, try to adjust at the same time. The result is not coordinated design, but spontaneous collision. Bhutan's role adds another layer. Over the past 2 years, it has become one of the more unusual sovereign Bitcoin holders, building holdings through mining connected to hydropower. This is not the typical story of a corporate treasury announcing a grand strategy. This has been quieter, more administrative, and therefore more mysterious to outside eyes. And mystery invites projection. Traders watch these wallets closely because they want to anticipate supply. Yet the market is not a mind reader. It is a process of discovery, and discovery often begins with misinterpretation. So we keep our logic disciplined. These transfers do not prove outright selling. Coins were split across multiple destinations, including fresh wallets that could suggest internal rearrangement rather than immediate liquidation. But we also admit what is plainly visible. Sending Bitcoin to exchanges and trading firms during a sharp drawdown is not the same as leaving it untouched. It is a choice to keep options open. Here's the deeper theme emerging in this sell-off, and you can see it across many large holders. Bitcoin is being treated less as a static monument and more as a balance sheet tool when stress rises. Corporate treasuries adjust. Minas adjust, and now sovereign-linked entities appear to adjust as well, because they too face opportunity costs, funding needs, and risk constraints. You might have believed that a reserve asset is defined by stillness, but stillness is only one strategy among many. When conditions change, purposeful actors seek flexibility. They do not abandon reason, they apply it. And so we end where we began, with a quiet signal. A once silent wallet moves, and the market listens. If you sit with this, you may notice the real lesson is not about Bhutan alone. It is about how every holder, large or small, is pulled between patience and optionality when uncertainty climbs. If you have ever felt that same pull in your own decisions, you already understand more of this story than any chart can show. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep Blocksonic running at full speed every day. Bitcoin slips beneath $70,000 as selling concentrates on Bitstamp. During Asian trading hours, Bitcoin touched $69,101 on Bitstamp. And that small break below a famous threshold reveals how prices transmit pressure, not headlines. You and I both know the paradox. One Bitcoin is one Bitcoin, yet in the same moment it can wear different prices in different places. We begin with human action. When people choose to sell now rather than later, they are not moving a chart. They are expressing urgency, fear, or a simple need for liquidity. Price is merely the visible trace of that choice. On Thursday, that trace continued downward. Bitcoin's sell-off pressed through the widely watched level of $70,000 on Bitstamp, an older exchange that still serves as a clear window into order flow when pressure builds. Now, notice the detail that matters. On Bitstamp, Bitcoin slipped to $69,101 during Asian trading hours. Elsewhere, the same asset held a slightly higher floor, including on Coinbase, where Bitcoin reached a low of $70,002. Here is the midstream question we should sit with. If markets are a process of coordination, why does coordination briefly fracture into a discount? The answer is not mystical. It is local. A price is formed where buyers and sellers actually meet. And where selling is heavier, the clearing price must fall until someone, somewhere, finds it worth buying. The discount on Bitstamp likely reflected stronger selling pressure on the platform owned by Robinhood. And once you see that, another implication becomes unavoidable: the famous round number, $70,000. It is not a law of nature. It is a psychological landmark. When action intensifies near such landmarks, you often see a sudden step down, not because the number has power, but because many people have attached meaning to it. Widen the lens with me. A global average price tracked by CoinDesk peaked above $126,000 in early October, and the path since then has been a downtrend. That is not merely decline. It is a sequence of revisions, as earlier optimism meets later constraint. Some analysts expect the selling to continue, perhaps at least to $60,000, where they imagine prices may eventually bottom out. Whether that specific level holds is uncertain, but the logic behind the forecast is familiar. When many holders try to exit, the market must search downward for the marginal buyer willing to absorb what others refuse to hold. So what do we take from this without superstition? When you see one venue print a lower price than another, you are watching dispersed knowledge made visible. Pressure is not evenly distributed, and the market's task is to discover where willingness to buy returns. If you have your own sense of what makes a level feel like a floor, keep that thought close and tell me where you think the next real test of conviction lies. Not on a chart, but in the choices people are about to make. Silver's 17% fall revives a liquidation pattern that can outrun Bitcoin. We need to look past the drama of a falling metal and notice the structure underneath it. When leveraged traders treat metals and crypto collateral as one balance sheet, a drop in one corner can force selling in another. This is the feedback loop Michael Berry pointed to, and it explains why metal liquidations can suddenly rival what you expected to see in Bitcoin. You might think a metal falls because people change their mind about its value, yet watch what happens when the seller is not choosing but being compelled. Over the past 24 hours, silver sank by as much as 17%, erasing a two-day rebound. The market was not calmly discovering a new price. It was searching for a floor after last week's historic rout, and finding none quickly enough to satisfy a leveraged patience. When silver moved, gold and copper were pulled lower too. Not because every participant re-evaluated every use case at the same instant, but because positions were crowded, liquidity was thin, and the unwind had to travel through whatever doors were still open. Now we come to the part many people miss, because they still imagine metals and crypto as separate worlds. They are not separate when the same trader uses one to support the other. The selling pressure can migrate across rails, the way water finds the lowest point. On Hyperliquid, one of the larger liquidation prints tied to tokenized silver appeared as a forced close of roughly $17.75 million in a product labeled XY, C:silver. About $16.82 million of that came from long positions based on trade data shared by market participants. I'm to pause here and notice what this implies. The trader who was long was not merely wrong. The trader was structured to be removed. And that is why rebounds in this environment feel inviting right before they become trapped. You have seen this rhythm lately. Participants lean into the idea of a bounce, volatility returns, and the market flushes the most fragile positions first. It is not personal. It is arithmetic, enforced by margin. This is the spillover Michael Berry flagged earlier this week. He described a collateral death spiral dynamic. Leverage builds as metals rise, then falling crypto collateral forces traders to sell tokenized metals to meet margin requirements. He even singled out how Bitcoin losses could push institutions to liquidate profitable metals positions. Here is the paradox that startles people the first time they see it. In this kind of tape, the liquidation leaderboard can look inverted, with metals products briefly doing more damage than Bitcoin itself. Not because metals became more important overnight, but because the constraint is not importance. The constraint is collateral. You might ask whether the larger story is macro headlines. They add noise, and sometimes they add timing. Markets are still digesting the policy implications of Kevin Warsh's nomination as Federal Reserve Chair, while President Donald Trump has pushed back on the idea that the Federal Reserve could turn more hawkish. Rate expectations do matter for precious metals, yes, but the bigger driver right now is simpler and more immediate: positioning, thin liquidity, and forced selling. What looked like a clean macro bid last month is being replaced by the colder logic of leverage, being reduced wherever it can be reduced fastest. So when you watch silver plunge and you see liquidations spill into tokenized markets, do not treat it as a mystery. Treat it as a map of human action under constraint. People act purposefully until their structure removes their ability to choose, and then the market acts through them. If you have seen this pattern in your own corner of markets, you already know how quietly inevitable it feels once you recognize it, and you may want to set down your version of it for others to examine. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep Blocksonic running at full speed every day. Bitcoin falls beneath $71,000 when technology optimism turns into liquidation. You are watching a familiar pattern. When confidence in future growth weakens, people sell what feels most optional, and Bitcoin is often treated as optional in the short run. We will trace how a rout in technology shares, doubts about artificial intelligence spending, and thin liquidity turn stories into forced selling. You might think Bitcoin moves on its own logic, yet it often bends to the same human reflex that moves crowded trades everywhere. In Asian trading hours on Thursday, Bitcoin slid beneath $71,000, and what looks at first like a crypto-specific event reveals itself as something broader. When people hold positions because they expect tomorrow to be brighter, and that brightness is questioned, they reach for the exit together. Over the past 24 hours, Bitcoin fell as much as 7.5%, touching lows near $70,700 before recovering some ground, based on CoinDesk data. Notice what matters here, not the exact low, but the speed. Speed is the signature of positions that were not built to be held through doubt. Now ask yourself why the doubt arrived. The selling pressure did not begin inside Bitcoin. It spilled in from global technology stocks. When technology shares fall sharply, the portfolios that own them are forced to rebalance, reduce leverage, and raise cash. And the assets with the most eager buyers yesterday often become the easiest to sell today. In Asian equities, concern grew that artificial intelligence spending may be cresting, that valuations had run ahead of earnings, and that earnings momentum itself was slowing. That combination changes the investor's calculation. The same future that justified high prices becomes less certain, and uncertainty makes people pay for liquidity. Here's the midstream paradox you should hold in your mind. The more an asset is praised as the future, the more it is bought by those who cannot tolerate a pause in that future. When the pause arrives, the selling is not philosophical, it is mechanical. The MSCI Asia Technology Index fell again for a fifth time in 6 sessions, led by steep losses in South Korea's Kospi, down around 4% as large artificial intelligence linked stocks came under pressure. A repeated decline teaches the market a new habit. Each bounce is treated less as recovery and more as an opportunity to reduce exposure. That weakness followed a slide in the Nasdaq during United States trading. Disappointing earnings from firms such as Alphabet, Qualcomm, and ARM strengthened the fear that artificial intelligence investment might be peaking sooner than expected. And when the market story shifts from limitless expansion to finite budgets, prices must adjust to the new imagination. This is where Bitcoin's recent behavior becomes intelligible. In equity-led drawdowns, Bitcoin has increasingly traded as a high beta risk asset, especially when liquidity is thin and uncertainty rises. You do not need a grand theory to see it. You only need to observe that many holders treat Bitcoin as something they can sell quickly to meet obligations elsewhere. Earlier this week, Bitcoin whipsawed, falling towards $73,000 and then rebounding above $76,000. Some traders read that as strength, but reason points to another interpretation: fragile conviction. A clean reversal is carried by patient buyers. A whip is carried by nervous ones. And once price pushed beneath the low 70,000 range, the market began to reveal what had been hidden under calm surfaces. Leverage. Wen Kai, chief operating officer at Sin Futures, described it as a broader deleveraging that flushed out crowded positioning built during the post-exchange traded fund rally. Liquidations were heavy, sentiment turned risk off, and price action became driven more by balance sheet mechanics than by narrative flow. Pause here, because this is the hinge of the whole episode. Stories attract positions, but leverage turns stories into obligations. When obligations collide with falling prices, selling becomes less a choice and more a necessity. Kai added that this does not signal the end of institutional participation, but it does mark the end of complacency. And that is a precise distinction. Participation can remain, but the terms change. The easy assumption that liquidity will always be there at a friendly price is what disappears first. Pressure was compounded by sharp moves in commodities. Silver plunged as much as 17%, and gold fell over 3%, extending a harsh unwind that triggered heavy liquidations in tokenized metals products on crypto venues. When multiple markets unwind at once, you are not seeing separate accidents. You are seeing the same human action repeated across different instruments. The urgent preference for cash and safety over exposure and hope. So, we arrive at the quiet conclusion. Bitcoin did not fall merely because of headlines, nor because of a single chart level, but because people who had arranged their plans around a certain future were forced to revise those plans under scarcity. If you have seen this pattern in your own life, in smaller form, you already understand the market. When the margin for error shrinks, we sell what we can, not always what we want. If that resonates, keep the thought close and tell us where you have noticed the same logic outside of markets. XRP falls to its lowest since the election euphoria. And the next floor looks uncomfortably near. You and I are watching a familiar pattern. When fear rises in the wider crypto market, even a token with a clear use case can be treated as just another risk to shed. XRP has slid to $1.44, its lowest since November of 2024. And the price action now hints at how quickly a market can search for the next place where real buyers still exist. You can feel the paradox immediately. XRP is described as payments focused, yet its price is being pulled by the same tide moving Bitcoin. When Bitcoin weakens, many traders do not pause to reevaluate each separate project from first principles. They simplify. They reduce. They sell what they can sell, because liquidity is a tool for regaining control under uncertainty. And so, what looks like an XRP story is often a story about risk appetite collapsing across the board. Notice how the market remembers narratives, but it prices present urgency. Back in November of 2024, the election win produced a wave of optimism about a more welcoming environment for digital assets. XRP, tied closely to Ripple and its cross-border transaction ambitions, benefited from that surge in confidence. Yet optimism is not a resource you can store. It must be renewed each day by fresh buying, and buying requires conviction stronger than the temptation to wait. Here is the quiet conflict. The initial reaction was bullish, but the climb slowed above $3.50, and the move ultimately topped near $3.65 in July of last year. From there, the trend turned, and in recent weeks the decline has accelerated. That is not merely a line on a chart. It is the visible trace of many individuals revising their expectations, one trade at a time. Now we arrive at the level that matters for understanding the present psychology. The price is firmly below $1.60, a zone where buyers previously stepped in during the April sell-off and halted the slide. In plain terms, that area was where demand once proved itself. When such a level fails, It is not magic that breaks. It is a belief that breaks. The market is telling you that the group willing to defend that price has thinned, while the group eager to exit has grown more urgent. Pause with me here, because this is where the next deduction becomes almost unavoidable. If the old demand zone is gone, where does the market go to find the next concentration of willing buyers? The charts suggest an uncomfortable answer. There's an air pocket down toward $1. Between $1.44 and that round number, there appears to be little historical support and relatively little traded volume to slow a fall. When a market has not previously negotiated much business in a range, it has not built much shared memory there. And without shared memory, there is less hesitation. You can also see traders preparing not just for direction, but for turbulence. On Deribit, recent flows showed interest in put spreads, which express a bearish posture with defiant risk, and in strangles, which are essentially a wager that volatility itself will expand. This is what people do when they sense that calm is the exception, not the rule. Options, after all, are simply contracts that let a buyer choose later rather than commit now. A put grants the right to sell at a set price in the future, aligning with downside protection or a bearish thesis. A call grants the right to buy, aligning with upside exposure. And when demand concentrates in structures that benefit from falling prices or rising volatility, you're observing expectations becoming more defensive. So we end where reason usually ends, not with certainty but with clarity. Prices are not moral verdicts, and they are not promises. They are the present outcome of countless purposeful choices under uncertainty. If you want to test your own understanding, sit with one question and see where it leads you. When support fails, is it the asset that changed first, or the minds holding it? Bitcoin drifts towards $70,000 as on-chain signals darken and traders expect April rate stillness in Asia. You are watching a market that is not collapsing from fear, but thinning from absence. We will walk through what on-chain behavior quietly reveals about demand, liquidity, and why many traders now expect no near-term relief from interest rate cuts. If you want a paradox to hold in your mind, take this one. Prices can fall, even when nobody is panicking, simply because fewer people are choosing to act. We begin with the simple fact of human action. A market price is not a verdict handed down from above. It is the momentary outcome of many separate choices to buy, to sell, or to wait. When more people wait, the visible world starts to look like weakness, even if the emotion underneath is not terror but hesitation. As the Asian trading day opens, Bitcoin hovers in the middle $70,000 range, and global equity markets still search for direction. That setting matters only because it shapes expectations, and expectations shape action. When uncertainty rises, the easiest action is inaction. Now we look at the on-chain signals, because they are traces of choice. CryptoQuant frames the current softness as structural rather than cyclical, with its bull score index sitting at 0, while Bitcoin trades well below its October peak. In plain terms, the market is not merely cooling after a run-up. It is operating with fewer committed buyers and with liquidity that feels tighter. Glassnode reinforces the same picture from a different angle. Spot volumes look weak, and there is what we can call a demand vacuum. Selling appears, but it is not met by steady absorption. Notice the distinction. This is not a story of crowds rushing for the exit. It is a story of fewer people entering the room. Hold that thought, because it leads to the next deduction. If participation is fading, then the marginal buyer becomes scarce, and scarcity of the marginal buyer is what makes support levels fragile. You can have a price level that looks strong on a chart, yet feels hollow when tested, because the will to buy is not there in size. Institutional flows add weight to this. United States spot Bitcoin, exchange-traded funds, which were net accumulators around this time last year, have flipped into net sellers. The result is a year-over-year demand gap measured in tens of thousands of Bitcoin. You do not need drama for that to matter. You only need arithmetic. Fewer steady bids means more price sensitivity to each wave of selling. Then we observe the Coinbase premium, a small signal that often reveals a large truth. It has remained negative since October, implying United States investors are not meaningfully stepping in even as prices are lower. Historically, sustained bull phases have coincided with strong United States spot demand. If that engine is idling, rallies can still happen, but they struggle to become trends. Here is the midpoint question you should ask yourself. What if the market is not over-leveraged, but under-convinced? In that world, liquidations are not the main story. The main story is that the buyer who would normally take the other side simply chooses not to. Liquidity tightens in quieter ways too. Stablecoin expansion often accompanies rising risk appetite because it supplies trading balances and grease for exchange. That expansion has stalled, with Tether market capitalization growth turning negative for the first time since 2023. Again, we do not need to romanticize this. Less new transactional money in the arena tends to mean less ability to absorb shocks. Longer-term apparent demand growth has also collapsed from last year's highs. That suggests something deeper than a leverage flush. It suggests participation itself is fading, which is the kind of change you feel not as a crash, but as a market that cannot quite lift its own weight. Technically, Bitcoin remains below its 365-day moving average, and on-chain valuation bands cluster major support in a corridor between $70,000 and $60,000. Treat these not as magic lines, but as places where many minds will make similar decisions. A support level is simply a meeting point of expectations, and expectations are real because they guide action. Overlaid on all of this is the broader macro backdrop. Bitcoin has been behaving less like digital gold and more like high beta software, meaning it moves with the same shifting appetite for risk that moves growth equities. When that is the pattern, the path of interest rates becomes part of the market's imagination. Prediction markets show traders leaning heavily toward no change at the Federal Reserve meeting in April, with only modest expectation of a June rate cut. If traders do not expect easier money soon, they also do not expect sudden liquidity relief. And when relief is not expected, waiting becomes rational. There is also a complication in the policy narrative, because public remarks can reshape beliefs about future decisions. President Donald Trump recently discussed his Federal Reserve nominee, Kevin Warsh, and suggested in an interview with National Broadcasting Company News that a chair who wanted to raise rates would not have received the job. The point is not the personalities. The point is that perceived independence, perceived pressure, and perceived future policy all alter the probabilities people assign to tomorrow, and those probabilities alter what they do today. So for Asia, the market is defined less by shock than by absence. Bounces remain possible because prices always invite opportunistic action. But conviction remains thin because thin participation cannot easily produce thick trends. Bitcoin drifted lower into the middle $70,000 range after briefly testing support, and rebounds faded quickly as spot demand stayed thin and technology stocks remained under pressure. Ethereum hovered just above the low $2,000 range, struggling to build momentum as broader risk sentiment softened, and flows stayed muted across major exchanges. Gold rebounded toward a range between $5,000 and $5,100, extending a volatile recovery tied to safe haven buying after United States and Iran tensions flared. While softer private payroll data offset mixed signals and traders reassessed the interest rate outlook under the new chair pick. Japan's Nikkei 225 edged lower by roughly 0.3%, with chip and technology heavyweights tracking the Wall Street sell-off, even as broader Japanese equities remained relatively resilient than some regional peers. Now we pause, because the underlying truth is simple and easy to miss. Markets do not move only on fear and greed. They also move on participation, on the quiet decision to engage or to stand aside. If you have ever wondered how a price can sag without a panic, you have the answer in front of you. If you find yourself seeing the market differently after this, hold on to the question that remains open. What would have to change, not in headlines, but in actual buying behavior, for absence to turn back into conviction? Bitcoin and wounded software shares are moving together more than you think. You and we are watching Bitcoin trade less like an outsider and more like a familiar kind of asset, software. As software shares absorb fear about artificial intelligence, Bitcoin's price begins to rhyme with that same anxiety. We will trace the logic of why this link is strengthening and what it quietly implies about how people are valuing risk, code, and the future. You might think Bitcoin stands apart from equities, yet it keeps falling in step with a very specific corner of them. We begin with a simple observation about human action. When people feel uncertainty, they search for categories. They ask, often without speaking it aloud, what this thing truly is. Is it money? Is it commodity? Is it technology? Is it a wager on the future? And whichever category wins in their minds becomes the path through which they buy, hold, or flee. Now watch what has been happening. Bitcoin has been correcting at the same time that software shares have been selling off. That is not a poetic similarity. It is a pattern of coordinated decisions made by many individuals responding to the same changing expectations. On a rolling 30-day basis, the relationship has tightened sharply. Bitcoin's correlation with the iShares expanded tech software exchange traded fund sits around 0.73. When that number rises, it is telling you that two crowds are moving with a shared rhythm, even if they believe they are acting for different reasons. And the price moves themselves are not subtle. The software fund is down around 20% for the year so far, while Bitcoin has fallen 16%. You do not need a grand theory to start. You only need to notice that the same kind of selling is touching both. Look at what sits inside that software fund. It is heavy with firms whose output is code and services. Microsoft, Oracle, Salesforce, Intuit, and Adobe. These are not factories of steel. They are factories of organized instructions sold at scale, defended by brand, distribution, and switching costs. Here is the next step in the deduction. At the headline level, the broader technology complex looks resilient. The Nasdaq 100 is only around 4% below its record high. Yet inside that calm surface, software shares have taken much of the pressure. So Bitcoin is not merely tracking technology in general. It is increasingly tracking the weaker pocket, the place where the market's doubt is concentrated. You should pause here, because this is where many observers get lost. They see an index near highs and assume the whole sector is healthy. But markets are not monoliths. They are millions of separate valuations, each one a judgment about an uncertain future. When the selling clusters in one area, it tells you where expectations are breaking first. So why is software being punished? The immediate answer being offered is artificial intelligence. Not artificial intelligence as a tool, but artificial intelligence as a threat to the defensibility of software itself. If software can be generated, modified, and replaced more easily, then the scarcity that once protected certain business models begins to feel less certain. And notice what that does to the investor's mind. If the future makes code cheaper to produce, then yesterday's profits from code look less durable. The market is not condemning software because it dislikes software. It is repricing the time path of expected earnings under a new technological possibility. Now we return to Bitcoin. and the connection becomes less mysterious. Bitcoin is code. It is a protocol. It is an open system maintained by voluntary participation and incentive alignment. When the market mood shifts against software as a category of value, Bitcoin can be swept into the same basket, not because its monetary properties have changed overnight, but because people often trade what they can categorize quickly. One analyst put it bluntly, Bitcoin has been caught up in the technology sell-off. At its heart, Bitcoin is treated like an internet stock. Software shares have been a recent casualty, and over the past 5 years, Bitcoin's price has shown similar performance with high correlation. You might object, Bitcoin is not a company. It has no quarterly earnings call. It has no management team to disappoint you. And you would be right in structure, yet still miss the point in behavior. In markets, what matters in the short run is not what an asset is in essence, but what people believe it resembles when they are trying to manage risk under pressure. Here is a mid-course question we should ask together. If Bitcoin is being traded as software, what does that reveal about the marginal buyer? It reveals that many participants are not holding it primarily as a long-term monetary shelter. They are holding it as a high volatility expression of technological optimism, and they reduce that exposure when the same optimism is questioned elsewhere. Another detail sharpens the picture. The average technology bear market is said to last about 14 months. If the current downturn began in October, that timeline suggests pressure could persist through much of 2026. We do not treat such averages as destiny, but as a clue about how long fear can remain socially coordinated once it takes hold. Yet even here, human action leaves room for reversal. A resilient economic backdrop can support Bitcoin because risk appetite is not a constant. When people feel their incomes and opportunities are stable, they can tolerate uncertainty in their portfolios. When they do not, they sell what feels most optional. And then we arrive at the final quiet provocation. Bitcoin is just open source software. That sentence can be read as dismissal or as revelation. If you hear it as revelation, you see the whole structure more clearly. Bitcoin is software, yes, but it is software with a monetary rule set, enforced not by decree but by voluntary verification. The market is still deciding which aspect it will price most heavily in any given moment. So we end with a calm recognition. The growing correlation is not a mystical tether between two tickers. It is the visible footprint of many individuals, categorizing, fearing, hoping, and reallocating under uncertainty. If you sit with that, you may start noticing a deeper pattern in your own thinking as well. When the world changes, we do not merely update prices, we update the stories we use to decide what things are. If you find yourself reclassifying Bitcoin in your mind after this, it would be worth hearing what category you think most traders are truly using right now. When Indian Bitcoin buyers see a dip, they see a decision. Indian digital asset investors are shifting from impulse to method, treating Bitcoin and other base layer tokens as long horizon holdings rather than short-term wagers. We will walk with you through what this change reveals, how people learn, how portfolios become deliberate, and how external constraints reshape the very way action expresses itself. You and we both know a dip can look like danger or opportunity, but the price itself does not decide which it is. What decides is the mind behind the order, the purpose behind the trade, the time horizon you choose when you exchange present certainty for future possibility. We are watching Indian investors behave less like headline chasers and more like planners, according to a Mumbai-based exchange called CoinCX. That is not a story about technology. It is a story about human action maturing under experience. When an investor stops asking, "What will the crowd do tomorrow?" and starts asking, "What is this asset for in my life?" you can almost see the shift in their hands. Fewer frantic taps, more measured entries, more patience with uncertainty. ONTX describes this as a movement away from sentiment and toward fundamentals and long-term potential. Notice what is quietly being admitted here, that the first stage of participation is often imitation, and the next stage is understanding. You can see this understanding in the methods people choose. Regular Bitcoin, systematic investment plans. Market orders placed with intention rather than adrenaline. Limit orders positioned as if the investor has already accepted that time, not excitement, is the main ingredient. And the preference set is revealing. Bitcoin and alongside it other large foundational networks such as Ethereum, Solana, and XRP. Not because smaller tokens cannot rise, but because when the goal becomes durability, the mind naturally seeks the assets it expects to survive its own mistakes. Now let us contrast this with the earlier pattern, because the contradiction teaches. In 2021, many newcomers pursued extreme multipliers, hunting for the next sudden surge, dabbling in meme clones and thin markets where hope could masquerade it as analysis. That was not irrational in the way people like to sneer. It was simply action guided by a different picture of the world. A picture where speed beats judgment and where the crowd's attention is mistaken for value. Here is the midpoint question you should sit with. What changes in a person when they stop trying to win quickly and start trying to not lose foolishly? CoinCX suggests participation is becoming more strategic and measured, with Bitcoin increasingly used for diversification and long-term wealth building. That phrasing matters. Diversification is not a slogan. It is a confession that the future is uncertain and that humility can be engineered into a portfolio. Prices, meanwhile, have been moving in the opposite direction of comfort. Bitcoin, they note, has fallen to around $75,000 after exceeding $126,000 in October. Broader markets followed, and many alternative tokens fell further. And as this is happening, the Indian rupee has weakened against the United States dollar, touching a record low around 92 rupees per dollar. You can feel the tension this creates in the saver's mind. The unit you earn in loses external strength, while the asset you watch can swing violently in the short run. So what do people do when both their familiar money measure and their speculative impulses are put under stress? They reveal their true preference for time. CoinCX reports that trading volume on the exchange rose from about $269 million in December to roughly $309 million in January, with activity described as more balanced. Balance is a quiet word, but it points to a living process. Some participants taking profit after buying near recent lows, while others accumulate steadily because they interpret current levels as a bargain relative to their long horizon. This is not one crowd. It is many plans intersecting in one market, each plan shaped by different needs, different patience, different fears, and different knowledge. Now we must introduce the external constraints because action never occurs in a vacuum. India maintains a cautious regulation-focused posture toward digital assets, treating them as taxable virtual digital assets rather than legal tender. The annual budget kept a 30% tax on gains, disallowed loss offsets, and maintained a 1% transaction tax deducted at source. If you want to understand what this does, do not begin with the rule. Begin with the person. Each added friction changes the calculation of whether an action is worth taking, and it nudges behavior away from frequent reactive trading and toward fewer, more intentional moves. Further requirements issued by the Financial Intelligence Unit mandate strict know-your-customer processes and regular reporting of user transactions by exchanges. Framed as measures for compliance and for countering laundering and illicit financing. Again, do not treat this as mere policy detail. Treat it as a constraint that reshapes the market's texture, Who participates, how openly, through which platforms, and with what tolerance for administrative costs. CoinCX notes that the Union Budget 2026 proposes stronger compliance expectations for crypto platforms, particularly around transaction disclosure, aiming to curb tax evasion in virtual digital assets. And here we arrive at the deeper pattern. When external impositions rise, some people leave, some people adapt, and some people become more deliberate. The market does not stop. It resorts. CoinTX closes by expressing commitment to working with rule makers to support a safe and innovative ecosystem as the landscape evolves. We will not tell you what to feel about that. We will simply show you the logic. Human beings pursue ends with chosen means, and when the environment changes, the means change first, then the habits, and eventually the very culture of participation. So when you hear investors are buying the dip, do not picture a single emotion called confidence. Picture 1,000 different purposes converging on one price, and notice how, over time, experience turns noise into method. If you have seen this same shift in your own thinking, you may want to put it into words, because the most useful map is often the one another mind draws from lived action. Thank you so much for following Blocksonic today. See you soon with more news, analysis, and market alerts. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.